Hello, guys. Today I'm happy to launch yet another paper, this time around financial reporting paper. That used to be called F7 in those days, but now it's FR. Yeah. And I would like to start by telling you this. This is one of the paper that you don't just want to read to pass. If you're ever going to be an accountant, if you're ever going to practice in finance space, this is probably one of your most important paper, because this is what gives you the understanding of what financial statement is all about and how those figures have been arrived. Right, so it goes beyond you trying to score 50 in this paper. I will personally advise you to go for 70 so that you know that you understand the content. I remember in my CFA days, this is also one of the most important papers in CFA exams. You can imagine, CFA is not so much of reporting, but this paper is actually probably the biggest in the whole curriculum. You will do it in level 1, you will do it in level 2, and the percentage in 1 and 2 quite a chunk. It shows how critical the understanding of financial reporting is. So please take note, learn it, and pay attention. And like I always say, if you have any question or personal support, you can always reach out. Yeah. So I would like to remind you quickly of the exam structure. Remember, this is still going to be 100% paper, and it's going to have 3 sections in exams. You're going to have section A, you're going to have section B, and you're going to have section C. Section A is 15 questions, which will be MCQ, and each will have 2 marks, which means you get 30% from section A. And this can be tested from all sections of syllabus. So question can come from any part of the syllabus. Section B will be 3 cases, and each case will have 5 questions. And each question will be 2 marks. So what this means is that you're also still going to have 30%. Likewise, all sections of the syllabus. Section C is slightly different. Remember, this is MCQ. This will also be MCQ, multiple choice questions. You choose whether A or B or C or D. But C is going to be of written response. You're going to write here. So here you'll be required to provide written response for section C, and there will be just 2 questions. And each will be 20 marks. So that means for section C, you are expected to earn 40% of your score. But this will not cover all the parts of the syllabus, but will only focus on section C and D. So section C and D will be your most important part of your syllabus, because just those 2 sections, you'll be expected to earn 40 marks from those sections. But that doesn't mean that the other sections are not important, but this is very critical, because if you don't understand this very well, it's very unlikely that you will pass this paper. So this is where I'm going to start the lecture, right? But before I go into the lecture proper, let's look at the syllabus. Syllabus is in 4 sections. There are 4 sections of the syllabus that we must cover. You have section A, section B, section C, and section D. Section A is on conceptual framework. Section B is accounting for transactions. C is ratio and analysis of FS, and D will focus on FS preparation, both single and group. Right. So this is the syllabus. In summary, what the syllabus is telling you is that the syllabus wants you to know two major things. Number one, how to account for transactions. And that is talking about standards, accounting standards, reporting standards. And here we'll look at 12 standards that will be covered here. And the second one is how to prepare both single, standalone, and consolidated financial statements. So this is what we'll be looking at in the next series of videos. And I must tell you that this is quite interesting. If you really pay attention, you will enjoy this paper. Used to be one of my favorite papers back in the days. Right. You will enjoy it. Just don't take it for granted. And most importantly, practice questions. Once you finish watching my video, please practice, test your understanding, and see whether you really got the concept or not. Right. So just to give you, like I normally do, a bit of introduction for each part of the syllabus. Conceptual framework. Here, what conceptual framework is all about is just the foundation of all the standards. In fact, I call conceptual framework the parent of the standards. All standards came out of conceptual framework. The basis upon which all the standards in financial reporting have been formed is from this conceptual framework. So we'll be looking at a bit of principles, terminologies, concepts, and principles of financial statement, recognition, measurement, the regulatory framework. Those are the kind of things we'll be looking at there. But in accounting for transactions, here we'll need to learn 12 standards. Yeah. And those are the tangible non-current assets. We look at intangible asset, impairment of asset, inventory, financial instrument, leases, provisioning, taxation, revenue, government grants, FX, and all. Yeah, so those 12 standards I will cover them. And the way I'm going to cover them is for each standard, I will summarize them into 3 sections, which will be the initial recognition, which is, take for instance, if we are looking at inventory standard, how do you know that this item is an inventory? That is initial recognition, right? And how much are we going to give it on that first day? That is where I'm going to break down each standard. And every standard you read, you must be able to summarize it based on that. That is when you know that you really understand the standard. Okay? And also, there's a lot of stories on standards. I know a lot of people don't like the standards. Yeah, probably because I've practiced a lot in consulting, in PwC, and all of that. I've trained companies on standards and everything. So you're going to benefit a lot from this. I'm going to give you a very quick exam-focused summary of what you need to understand every standard, whether you are practicing or you are writing exams. So initial recognition will be part 1, and the second one will be subsequent measurement. Subsequent measurement. How do you measure after the initial recognition? After the initial recognition and measurement, how do you measure going forward? Then the third part will be the disclosures. For every standard, there are requirements on what you must disclose. Yeah, so for every standard, this is how we will deal with it. We must be able to talk about initial recognition, subsequent measurement, and disclosures. And this is about analyzing financial statements. So we'll be looking at different types of ratios here and the interpretation of the ratios. Remember, at your level, you are not only going to expect to be able to calculate ratios, but you must be able to interpret the ratios. and tell the users what it means and what they can infer from the ratios you've calculated. This is the biggest chunk of the syllabus, and arguably, from all the comments I've been getting to start this paper, this is the most difficult for students. And that is where I will actually start my lectures from. Yeah, I understand a lot of students struggle with this. Yeah, but I'm going to help you, and I promise it will not be a nightmare to you any longer, because you will be very comfortable. Just stay with me on it and you will be fine. You will surely gonna be fine. Here, what do we want to look at? Basically, what we want to look at is how to prepare financial statements. So you're going to look at preparation of standalone financial statement, single entity, which is pretty easy. Where the work is consolidated financial statement. Here you'll be expected to be able to prepare consolidated statement of financial position. Likewise, you'll be expected to be able to prepare consolidated statement of profit or loss and other comprehensive income. And not just for one parent, one subsidiary, but parent, two subsidiaries, and associates. If you don't know what all of this means, don't worry. I'll take it step by step. I will explain all of them later. But that is just the summary of the syllabus. So that is what we're going to be looking at. And I'm going to start this particular series with section D. Like I said, from all the feedbacks I've received, this is where a lot of students struggle. It's section D. So we're going to do justice to it, starting from now. So we'll go into the group preparation of financial statement. Group. That's what I'm starting from. But before I go into those details, I need to explain to you forms of investment. Let me just do a bit of revision for you. You probably have seen this in your FA, but you need to remember before I move forward. So, for every time you invest in an entity, your investment can be categorized into, it can either be any of these four. If you have bought less than 20% of that entity, take for instance, if the company's shares is 100 shares in total, and you only bought 19 shares, what you have here is just ordinary investment. And this is measured at fair value. If you decide to buy between 20% and 49%, this type of investment is called associate. And this is measured using equity accounting. Don't worry, we'll go into what all of this means as we progress in the study. This part, we'll deal with it when we talk about financial instruments. IFRS 9. So when I'm looking at those 12 standards later, these 12 standards that I touched here, one of the standards is financial instrument, and that is this form of investment. This one is associate. I will talk about it in section D of the syllabus, and the measurement is equity accounting. If you decide to buy 50%, what you have is a joint operation, and that is also at equity accounting. But if you buy more than 50%, this is called a subsidiary. And this one you measure initially at cost. So initially going to be at cost. However, you must consolidate. There's some exceptions to consolidation, which I will touch on. Yeah, things like if it's an investment, if the parent is an investment entity, if the entity is also a subsidiary of another parent. So we'll go into all those details later. But have this summary. Let that be clear in your head. First of all, that you can have investment in any of these 4 categories. And depending on where it falls, your measurement will be different. And the name also will be different. So you must know when you have ordinary investment, when you have an associate, joint operations, or a subsidiary. Excellent. Now let's go into the concept of control. What is concept of control? This you need to understand, because when you have a subsidiary, what you're saying you have is control. This is the only investment that gives you control, investment in subsidiary. However, is it just by 50%? It's very important to understand the concept of control, not in terms of numbers, but rather 2 things: power to govern the affairs of the company, and also variable benefits. So if a parent is saying that he owns a subsidiary, it means that parent has power over the subsidiary to control the affairs of that subsidiary. The parent can say, stop making that product, or let's introduce another product, or I am firing the CEO. If you can make such important decision, you can direct the affairs of the company, then you have control. And if you taking those decisions entitles you to some benefit, e.g., dividend. The combination of these 2 things gives what we call control. So an example to know that these 2 things exist is ownership of more than 50%, because ownership of more than 50% most likely will give you the majority seats on the board. So when you have 10 people on the board, most likely you have 6 or more than that on the board. And when it's time to vote, you're always going to be the majority. So you can direct the affairs of that subsidiary. So it is possible for ownership to be less than 50% and you still have control. If substance over the form says that you still have power and you have benefit. So I'm telling you that, but most importantly, or most likely, for this paper, you will always not have that confusion. It will be clear that there is more than 50% ownership. But in theory, you can be asked, so you need to understand that less than 50% doesn't mean lack of control. Less than 50% can still be a control if you can demonstrate that there's a contract that shows that the company can control the affairs, which means it has the power, and also it gets benefit from the subsidiary. Both of those things, if they exist, then it is control, regardless of the percentage holding. Please take note. Like I said earlier, this paper I'm going to be teaching you not just for you to pass, but for you to be well grounded, even as you work in finance department or wherever you are, or in consulting. Right. So that is concept of control. And what it means is that if you control, so there's a requirement. If you have control, and the requirement is that must prepare financial statement. That is group in nature. So you must prepare consolidated. You must prepare consolidated FS. And what is consolidated FX? Consolidated FS is just saying you must add the parent financial statement to this subs. You must add it. Because the parent FS, this one is a single FS. Sub also has a single FS. When you merge all of them together, they become a group FS. And that is consolidation. That is consolidation. Now, must you always prepare consolidated financial statements? That is, I'm sure, the next question that should be going on in your head. Must you always prepare consolidated FS? Well, you don't always have to prepare it if some conditions exist, right? If some condition exists. Remember what I said, it is a requirement that you must prepare it. However, you can claim not to prepare it under these exceptions, which you need to know. And the first one, which I'll mention to you, is that if the parent, the so-called parent, that parent is a subsidiary of another entity. And I'm sure you can understand what I'm saying here. Imagine you have this parent that owns a subsidiary. And this parent is also owned by another parent. So this guy can claim that exemption. Can claim that, and it's this guy that will now consolidate this and this. So if the subsidiary is, if the parent is a subsidiary of another entity, and all its owners agree that the consolidated financial statement need not to be presented, yes, you can claim not to present, because this guy will now consolidate. Right. The second thing you need to know that is good exception is that if the parent company, this guy, the parent company, if it is an investment entity. If it is an investment entity, then also you can claim not to consolidate. And you can understand why this will be the case. You know what an investment entity is? Investment entity is just like a fund. And what is a fund? Fund is a basket of financial instruments. Probably shares. It can be private equity, which is still shares. Can be bonds. And just like that. So when you have financial instruments must be measured at fair value. When we get there, you will see. So in that case, you don't consolidate, because it's not the current value that is important. For people that have given you money to help them invest, remember how fund works. Fund is a basket of instruments. People have given you money and you are managing their money for them. And what you are investing in is investment for those people, because they are interested in the market value of their instrument, of their investment, and not consolidation. So in that case, you need to reflect everything in that fund at fair value. And that is why if such parent company is a fund, then there is no need to do consolidation. So please take note of those two exemptions, why an entity might not prepare consolidation or prepare consolidated financial statement.